Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Recession, is it going to happen? Inflation, is it going to go away? Unemployment, what's happening? Bank failures, all are big issues in the economy right now and in the news right now. And I just received a podcast from Capital Economics, an organization that I quite respect and follow, where the senior global economist Simon MacAdam explains the strong signals that our financial conditions indices are making about coming recessions. So I thought I'd reach out to him to see if he could enlighten us. Simon, welcome to our show, sir.
Yeah, well, thank you very much for having me, Brian.
My pleasure. So tell me, do you think we're going to get a recession? What are financial conditions, financial indices showing us?
Yeah, well, I think we are. Our base case is that we are going to have recessions this year. I mean, what we've created is a financial conditions index, as you say, which is a bit of a sort of a technical construction, but the big picture is that central banks, the Bank of Canada, the US Federal Reserve, the Bank of England here in the UK, have all been jacking up interest rates over the past year or so in order to try and quell inflation, which is far too high. But the question is, okay, the central bank is raising interest rates, but how does that actually affect the economy? How does that actually feed through to the real economy, to firms and households? And how does that affect inflation? And we would argue that happens through the financial markets. It happens through the cost of your mortgage. It happens through the cost of a loan for businesses. All of these things are what we call financial conditions. So you have the central bank raising its interest rate, but that feeds through to the real economy through all these other channels. And there's so many channels out there and so many different asset prices and interest rates and costs of borrowing that you could look at. The whole point of a financial conditions index is to sort of reduce all that down into one line. So just boil it all down to what really matters. And that's what we've produced. And these sort of indices are really at alarming levels. So, they are reflecting the fact that everything is a lot more expensive. People's mortgages are becoming more expensive and so on. So on that basis, people are going to have to really think about whether they can afford to take out new credit. And a lot of investment, a lot of spending is funded by new credit, whether it be from the banks, whether it be from the financial markets. So if everything's become a lot more expensive, then perhaps they're going to have to do less of it, and they're going to have less money left over to spend on goods and services and keep the economy afloat. So yeah, we think that financial conditions are very restrictive, things are very expensive, and that's going to have to tip economies into recessions. Not big recessions. We're not talking global financial crisis sort of levels of recession, but recessions nonetheless.
The second largest bank in Canadian and U.S. history failed this past weekend. Is that because of this action that the U.S. Fed is taking?
Yeah, I mean, this is part of a big story, right? You had an era of very low interest rates, and banks acclimatized to that era of low interest rates because inflation wasn't a problem before the pandemic. If anything, central banks were trying to get inflation up, not down. So you had banks get used to that. Banks position themselves for a world that would continue to look like that. And of course, then the pandemic came along, the world changed very much so. We've got higher inflation, higher interest rates. And this is starting to reveal that some of the weaknesses in some parts of the system. Now, the big banks in the US, like big banks across most of the world, are highly regulated and highly supervised. The problem is in the US, there were some rollbacks in the regulation and rollbacks to the extent to which banks were supervised. So consequently, some skeletons have been in the cupboard about balance sheet management, about risk management in some financial institutions. Obviously, we had SVB, Silicon Valley Bank. Now we had Signature Bank. Now we've got First Republic. So yeah, this is being exposed. These financial vulnerabilities are being exposed by what the Federal Reserve and other central banks are doing with interest rates in order to quash inflation. These are the consequences.
It also had a little bit of an international impact with CSFB, did it not?
Oh, yeah, absolutely. This is the thing with a banking panic, right? You start off with a fundamental problem, but it starts to take on a psychological element. It focuses everybody's attention. Oh, well, if that bank could fail, will this bank fail? And so everybody knew, for example, when Credit Suisse in Switzerland, they were gobbled up by UBS, the other big bank in Switzerland, in a sort of a state brokered deal. Now that people have known about Credit Suisse's problems for years, but no one was expecting the idea that this major global player in global banking was going to collapse this year. No one would have forecast that at the beginning of this year. But what started in the US focused people's attentions on banking vulnerabilities. which then highlights them in the mind. So then you go looking, well, who's next? And then you start to reflect on, oh, hang on a minute. Yes, Credit Suisse and this bank and that bank, they've had weaknesses that we've known about for a long time. Perhaps things are worse than we can see, because things are, the banks are relatively, big banks in particular are reasonably transparent in their reporting, but in real time, it's very difficult to gauge exactly how things are developing on the ground. So, for example, First Republic is an excellent example. First Republic was a very weak bank. It's been suffering in the markets for months now, ever since SVB collapsed. But it's taken a renewed turn for the worse, and obviously it's been collapsed, and now it's now collapsed, and JP Morgan is assuming its assets and liabilities right as we speak. And why is it had this sudden leg down? Why is it suddenly collapsed? And it was partly because it was motivated by the fact that it revealed that they had an almighty deposit outflow, far bigger than people were expecting in March and April. So it's this sort of, in real time, it's hard to know how bad things are. And now that we know how bad things have been for First Republic, that's now pushed it over the edge. So yeah, this is a problem. US banks in general have this ongoing problem of deposit outflows. You see, in Canada and in the UK here, the notion of a money market mutual fund, to most people know what it is, because they aren't really a big deal in our economies. So a lot of households and firms don't deposit their cash in a money market mutual fund, they deposit it in the bank. Now, in the US, money market mutual funds are a far bigger deal. And things about money market mutual funds is they pay far higher interest rates on deposits than your standard bank account. So in an era of high interest rates like today, depositors are going, right, well, the bank is paying me almost nothing. It's paying me peanuts. But this money market mutual fund over here, this is paying 4 or 5%. So I'm going to withdraw my money from the bank and put it over here. But so this is happening across the US banking system, that you're having a sustained deposit outflow. This is irrespective of the particularly acute vulnerabilities of certain banks, right? So SVB had particular problems. So First Republic has particular problems. But the US banking system as a whole has a macroeconomic problem, that the Federal Reserve has been raising interest rates in order to contain inflation. And that is causing people to take their money out of the banks and put it in these money market mutual funds. So for as long as that process continues of the sustained deposit outflow, banks, they might not be toppling left, right, and center, but they're going to be cautious. And the appetite to lend is going to be reduced. So we're thinking about coming back to the question that we started with about how expensive borrowing has become. That's only one side of the equation. Because even if borrowing has become a lot more expensive, some people might reckon, well, okay, this mortgage or this loan has become a hell of a lot more expensive to service, but you know what? I still want it. I still need it. I think there's an opportunity to grow here. So I'm going to take on this liability. Not so fast. What happens if the bank is not willing to lend you that money because they are concerned about their own finances, because they are losing deposits, this sort of like slow drip feed of deposits leaving the system. So this is an issue that's going to last into the second half of this year, into next year possibly as well. So long as interest rates remain high in the US, so long as money market mutual funds continue to offer relatively attractive rates for savings relative to banks, you will continue to see this slow bleed and this continued aversion on the part of commercial banks in the US to lend. And that's going to reduce the finances available for the real economy, for businesses and firms, and ultimately slow down the economy and possibly help tip it into a recession.
So are you suggesting that we should be surprised if we have more banks that fall into to failure? In 2008, 2009, it started with Bear Stearns and Lehman Brothers, but it quickly spread to Goldman Sachs and AIG, and the government had to step in a fairly major way. Are we going to have a repeat of that, do you think?
See, the thing that's very different today than compared to the global financial crisis. Well, lots of things are different, but I suppose particularly the problem back then was that a lot of banks, big banks as well as small banks, were exposed to a toxic asset that people didn't really know where it was. It was very opaque. So back then, of course, the skeleton in the closet were mortgage-backed securities and collateralized debt obligations. So these were basically security products in financial markets where they bundled together a load of residential and commercial mortgages, bundled them together into security, and then trade those securities. And everybody thought that these securities were very, very, very safe investments. They were diversified, and they sort of aligned to all those good investment principles about why it should be a safe and attractive asset to invest in. But of course, when the underlying mortgages were defaulting, people got very concerned about who was holding these assets. and people didn't know who was holding these assets and where the exposures lay. And consequently, even big players were embroiled in a general sense of uncertainty and stress and concern about the health of the banking system. That's different today. So the big players today, the problem today isn't that there's a particular asset on banks' balance sheets, on the balance sheets of big banks like Goldman and Morgan Stanley and JP Morgan. People aren't concerned that they're holding something that it could turn out to default in a very big way and blow a hole in their balance sheets. That's not the problem here. So I think from that point of view, we're not seeing a sort of rerun of the global financial crisis. This is more of a deposit outflow for the whole system. It's more about lending aversion rather than a collapse in confidence in the banking system as a whole. So I think there are reasons to be relatively optimistic that we're not going to have a repeat of what happened back then. But that's not to say that there won't be more banks to fail. It's just that I'd be very surprised if some of the very big players ran into serious problems. So we've had First Republic now, others may follow. I think a better parallel actually from history is when it comes to banking strains is less about the global financial crisis and more about the savings and loans crisis in the 1980s. I mean, back then, that was in a big way. I mean, the US lost a third of its banks. I think over 1,000 banks collapsed over the course of a decade. Now, I don't want to be quoted as saying that Simon MacAdam of Capital Economics thinks 1,000 banks are going to collapse in the US. But I think it's more analogous in the sense that we have smaller institutions over prolonged periods of time falling one by one without it having major macroeconomic implications whereby the whole economy goes into a deep recession because the banking system's collapsing. I don't think that will be the case.
Well, the savings and loan crisis is a bad analogy. If there's thousands of banks, we've had 4, I think, that have failed so far. So long way to go, big impact to come if that's the right analogy. Anyway, I won't quote you on that, but thank you for the warning. We're going to take a break for some messages and be back in 2 minutes with Simon MacAdam of Capital Economics talking about the potential for a recession this year. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Simon MacAdam. He's coming to us from London, UK. He's a senior global economist with Capital Economics. I listened to a really interesting podcast just last week that he had in regards to financial indications of a coming recession. And I found it really quite interesting. Simon's really quite a smart gentleman. He's got a master's of science in economic history from the London School of Economics. He's got a really interesting background at Capital Economics. He conducted research into the impact of Brexit on Scotland's economy. He worked in the commodities team and developed a metal consumption proxy framework, talking about the demand side analysis of industrial metals. He worked on the global markets team, looking at capital and how it impacts us all. He then was an assistant economist and then became a global economist, a senior global economist, producing analyses on policy tightening, inflation, protectionism, oil price moves, financial market fallout, changes in Fed policy, etc. Obviously, extremely bright gentleman and well experienced. And so thank you for sharing your expertise with us. I got a challenge, though, because I'm just a fun reader of current events and newspapers and stuff like that. One of your comments about this contagion and that it not impacting the balance of the economy and not having that product, the mortgage-backed securities that you talked about, 2008, 2009. 99-year-old Charlie Munger, the number 2 person, or some people would say the equal partner at Berkshire Hathaway, just this weekend warned people about property loans and that could be a major problem. And specifically, I think he was worried about loans against shopping centers and office buildings in the United States, and that a lot of those loans were lent by lent by banks all around the United States, like First Republic, like Silicon Valley Bank, regional banks, not necessarily the big major money center banks in New York. And he worried that they were over-levered and wouldn't be able to withstand maturities if they came to maturity and they had to refinance themselves, and that he was worried that might lead to major problems. What do you think? Is there a potential problem. You already talked about how banks are going to be lending less. I've had recent personal experience that banks are lending less as a percentage, and that may be because they think values are down, and so therefore the percentage may be the same of what real value is, but it's less as a percentage of what the borrower thinks the value is, and the interest rates are clearly higher, and the terms are becoming tougher. And so, is property loans a potential risk?
Yeah. So coming back to what we were saying earlier, the question was about whether the likes of Goldman Sachs and some of these very, very big players were going to have the sort of problems that they had in the global financial crisis today. And I don't think that's the case, precisely because I don't think there are serious concerns about the quality of their assets on the asset side of the balance sheet. That is a different concern for the small and medium-sized regional banks in the US. So they have a very, very big exposure to commercial real estate. So it is far, far bigger than that is held by the big banks. So just the small banks themselves have, I think it's about 2.3 times the number of commercial real estate loans on their balance sheets as all of the big players put together. So they are a major source of finance here for commercial real estate. Commercial real estate is heavily dependent in the other direction on those small and medium-sized regional banks. So there's a dependency, quite a dangerous dependency here, that commercial real estate is a big part of the assets of the banks, of the small banks, and small banks are a big part of the funding of commercial real estate. So absolutely, there's definitely a concern here. Commercial real estate values have been falling recently. They've probably got a lot further to fall, particularly in the likes of office space. I mean, they have been, people have been knowing about the problems of the retail sector because of the shift to online sales for quite a while now. But of course, the pandemic and the shift towards working from home has really been came out of the blue. And so there's been a far much of a shock to the commercial office space sector. So those guys, they've got a lot of debt and they're really struggling. They've got really big high vacancy rates in offices. People aren't coming back to offices in the US in the same way as they are in other parts of the world. So yeah, so they've got problems. They've got problems refinancing. You see, the things about the US, you have households with like 30-year fixed mortgages, right? So they don't really have a refinancing problem. When interest rates rise, when the Federal Reserve is jacking up interest rates, the average household in America, the average homeowner, is insulated from that. They don't feel it. They've got a 30-year fix. Every time interest rates fall, they refinance and make sure they get a cheaper and cheaper deal, better deal as time goes on. But when interest rates rise, they don't get hit by that. That's much less of an issue for commercial real estate. The fixed terms on their mortgages are much shorter. 3 to 5 years is far more common. So consequently, it doesn't take a huge amount. In any given year, you have a lot of commercial real estate firms who have to refinance. But the problem is interest rates now are a hell of a lot higher than they were 3 to 5 years ago. So you're going to have a lot of commercial real estate developers who are going to be struggling to refinance at such high interest rates. And the collateral value that they're underpinning these loans, i.e. the value of the properties that they're holding in their portfolios, they are falling and have further to fall. So you've got falling property values at the same time as interest rates are really high. This is going to cause serious refinancing problems for parts of commercial real estate. And consequently, that's going to impact on the profitability of banks. This underscores the point that I'm making, that banks, particularly small and medium-sized banks, are going to be very, very risk averse, very hesitant to lend out to projects that they're not highly certain that they're going to actually be repaid on, precisely because of these risks, both on the assets and liability side of their balance sheets. But that sort of concern is more for those regional banks. It's less about the big players that could have sort of global implications for the health of the financial system.
So that's why you think the savings and loan crisis might be a better analogy. So are you suggesting that you think there's going to be lots of other small and regional banks that are going to fail, or what do you think is going to happen?
I don't have a crystal ball. As the problem here is that there is a certain amount of information we have about the strength of the balance sheets of small and medium-sized banks in the US. But as I say, in real time, it's very hard to know about the particular loans and the particular exposures that an individual bank has to commercial real estate. Is it likely that more banks will fail, that there'll be more collateral damage from the Fed's tightening cycle in terms of the more small and medium-sized banks falling victim and collapsing? Yeah, I think so. But I mean, I'm not going to sit here and put a magnitude on that, how many banks I think is going to fail. I think that would be disingenuous on the part of being an economist.
Now in Canada, we don't have all those small and regional banks. And the people that have lent that money into property are the big banks, and as well life insurance companies and pension funds. So are you at all concerned about what might happen in Canada?
I'm afraid I'm no expert on the health of the Canadian banks, or about the scale of the problem in office and retail sectors and commercial real estate. So, for example, I know that the US have a particular problem of very high vacancy rates in parts of the country. You know, San Francisco has got a terrible problem of very, very high vacancy rates. The rents just aren't coming in, and those property developers are really struggling. I'm not sure. Maybe you can tell me about the extent to which the vacancy rates are so high in Canada. I'm not sure about that. But if they do have a problem like the US, where they have very high vacancy rates, then that means that those commercial real estate lenders are also going to struggle to refinance in the years to come.
You know, vacancy rates are higher. And more importantly, I guess, in the short term, is just that the offices are vacant, even if they're paying their leases. People are still working in a hybrid kind of scenario. And I guess the other thing is that, you know, almost every week there's another retail chain that is declaring bankruptcy, and so therefore, you know, even if they've got leases that have got term on them, the question is how long are all those retailers going to survive? You know, just this past weekend, it was Bed Bath and Beyond, and before that, it was another big chain that fell. And so, I guess, you know, the issue is, and maybe it's connected to your issue about inflation. As inflation goes up and people stop buying as much, and you know, internet to purchases by connection, isn't there a logical extension that you're going to have retailers that are going to be suffering?
Yeah, and this is, you know, this is all part. I mean, really, this is how monetary policy works, right? You know, the central bank is deliberately raising interest rates to deliberately make financing hard, to deliberately slow down the economy to cool inflation. So the fact that parts of the economy are struggling, and that we always find somebody who's particularly bad, you know, suffering, and that the banks are going to suffer some losses from all of this, and they're going to become risk averse in their lending. That's part of the course. That's what happens in the textbooks.
So what does a business do? What does an individual do in this situation? You know, J.P. Morgan swept in and bought First Republic Bank. You know, some people would argue they're buying a crippled asset. Other people might say they're buying it on the cheap because of the situation. So is this an opportunity for companies that have got cash to buy struggling businesses, or is it only going to get worse? And you got to be really careful, and you should husband cash.
Well, for those big corporations, whether they're banks or otherwise, yeah, the opportunities as valuations are falling, and if you're sitting on a pile of cash and you don't really want to deploy it because you think the outlook for growth isn't so good, so you don't want to start going on big investment projects when you don't think the economy is going to do too well. Acquiring other firms is an option to you. So there could be scope for consolidation in some of these sectors. In terms of what households do, I mean, the expectation is that households have to sort of really think about, they've got choices, right? They've got choices that if their credit is becoming more expensive, they may not take on debt. They may not want to take out an auto loan to buy a new car. I mean, this is all what the central banks are wanting. They're hoping for you to make these decisions, to pull back a bit and not spend so much on goods and services, because this is all what they're trying to do. They're trying to slow the economy. This is how it works.
You know, I really want to ask you if this is the right strategy and how we got into it. So I think what we're going to do is we're going to take a break for some messages and come back. And I'm going to ask Simon, if he was a central banker, would he be doing exactly this strategy? Stay with us, everyone. We'll be back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour. We're chatting tonight with Simon MacAdam. He's a senior global economist with Capital Economics out of London, England, and he's been commenting about, you know, what's happening in the economy right now with increases of interest rates by central banks, and that it's obviously, as we all know, planning to slow down the economy by increasing interest rates, making credit less available. Simon, 2 questions, if I could. How do we get into this situation? And number 2, is this the right strategy for getting out of it?
Yeah, so why are we going through this very, very aggressive increase in interest rates? Is to contain inflation. Why did inflation get out of control? That's a multifaceted question. I think the big the big underlying problem here was about the nature of lockdown, the nature of the pandemic, and what that did. So obviously, in order to if you cast your mind back to early 2020, we were all really seriously concerned about whether we were staring a sort of a Great Depression in the eye. Were businesses going to survive lockdown? Were they going to make it out to the other side as entities that could stay afloat and be commercially viable and employ people and give people incomes? And consequently, policymakers, both the central banks and governments, act in a very forceful way in Canada and the US and the UK and elsewhere to support businesses, to provide a financial bridge, to get businesses across the line, to get them through lockdown, to come out the other side and to stand on their own 2 feet. They also, in the process, were having to subsidize people's incomes as well, households' incomes as well. So all of our pay was supported by government to varying degrees. And consequently, we had an economy that actually managed to get through lockdown. So that's great. The Great Depression 2.0, that was avoided. But there were problems. And one problem was that as we were starting to reopen and normalize, we all had this, a lot of people had managed to save a lot of money throughout the pandemic. So some people really struggled. But if you look at the households and firms in aggregate, they had a lot of cash because they hadn't been spending very much, but their incomes had been supported. So they had a lot of demand and they were ready to spend. And there was a great willingness to go out and spend again. Problem is that it's all right, everybody wanting to spend on goods and services, but what happens if those goods and services aren't particularly available? They aren't in ready supply. And this was the bit of the problem that we had. And this is why part of the reason why we have such a high inflation rate across advanced economies, because demand was very high, but supply was constrained in various ways. And demand wasn't just high, it was excessively high because our incomes had been supported, you see, by the governments. So you had too much demand, too little supply. You had supply chain problems. It took forever to get anything ordered and to get anything delivered because of supply chain problems spanning across the whole world. You had commodity prices were starting to rebound as we were reopening. So everything, your oil and your gas and your metals prices, they were all rising. I mean, of course, Canada benefits from a higher oil price. You're a big producer of it. But for advanced economies as a whole, it also makes everything more expensive because it's a key input of production. So you've got higher energy prices. You've got supply chain problems, so making goods prices higher. And generally, you've also got the fact that a lot of people are staying at home. A lot of people are very cautious about returning to the workplace in full. Some people took early retirement, so the labour force was shrinking for that reason as well. Some people were suffering from long COVID, or if they weren't suffering from long COVID, they had other health problems because there were backlogs in the health systems and the hospitals. So whether it be because of health problems, whether it be because of your lifestyle choices, whether because of early retirement, labour forces were also smaller. Canada is another outlier here. You've had a lot of immigration, so you've been supported in this regard. And this is why arguably you've got less of an inflation problem than elsewhere. Your core inflation rate is a lot lower than in other advanced economies, partly helped by the fact that you don't have such an acute labour supply problem because of higher immigration. Other advanced economies haven't benefited from high immigration. So consequently, we've got a problem here. Too much demand, too little supply, too many people dropping out of the labour force, too many people with too much cash to spend, all at a time when commodity prices are rising. So there's your inflation, there's your recipe for inflation. And then, of course, the cherry on the cake here was Russia's invasion of Ukraine and really pushing up, particularly in Europe. I mean, gas prices rose in North America, but my goodness, did they rise in Europe? Astronomical prices. Now, governments help shield the increase of wholesale energy costs to some extent, but most of the burden did fall on households and firms. So that makes everything more expensive to produce. If gas is such an important part of the energy production mix, and it becomes so expensive. So that also helps fuel inflation. Combine all that together, we have inflation that's way, way too high. Nobody wants it this high, particularly the central banks. They're all targeting something like 2%, but they were getting rates across economies that were 7 to 12%. So that's where we got to in terms of inflation. That's the motivation for central banks raising interest rates to cool the economy in order to fundamentally redress a supply-demand imbalance.
So did the governments support the households too long? Did they put too much money into to the economy to support businesses during the pandemic? Did they keep interest rates low too long? Did they get it wrong that the pandemic wouldn't be nearly as catastrophic as they originally thought?
So that sort of question is an interesting one, isn't it? Because you can answer that from what we know now, or you can go back in time. and think to yourself, with the information that you had at the time, what would you have done? And they are I would give slightly different answers to those questions. So now we look in retrospect, did central banks leave interest rates too low, too long? And did governments in some countries offer too much support for too long? I'd say yes. But at the time, you were facing asymmetric risks. It's all right now that we've come out of lockdown and we're okay on the COVID front, more broadly speaking, and the economies have got back on their feet again. But at the time, in 2020 and 2021, we didn't know that. We didn't know. Back in 2020 in particular, we didn't even know about the Pfizer vaccine until much later stage, towards the end of the year. And it wasn't in 2021 before we were beginning to think that maybe the end was in sight and the light at the end of the tunnel. So if you cast your mind back to how things were, no, I don't think I think that the amount of policies accommodation that was provided by governments and central banks was entirely appropriate because the asymmetric risks that they faced. Yes, on the one hand, they might. This is also, you've got to cast your mind back that we've been used to over a decade of very low inflation. Central banks were actually sort of doubting that inflation could really get very high. Economists were doubting that you could see 10% inflation in an era of globalization, of technological development, of
no one forecast that.
Say again?
No one forecast that.
No one. This is just outrageous. So if you put your mind back to 2020 and 2021, you're thinking about economic relationships. No one would be expecting 10% inflation. You could, the vaccines may work. We may be able to reopen. We may be able to get the economy through this, but we might not do. Imagine if the governments hadn't been handing out support to households, and imagine if central banks had been raising interest rates back in 2020 and 2021, there would have been absolute outrage. So did they do the right thing at the time with the information that they had? Yes. In retrospect, was too much support given? Yes.
It's interesting. I saw a interview of Joe Biden, the president of the United States, and he was saying that he was in the White House as vice president after the Great Recession in 2008, 2009, 2010. And he said that we got it wrong. We didn't put enough incentive into the marketplace. We didn't put enough growth capital into the marketplace. And therefore, coming out of the Great Recession, it was slow. It was anemic growth coming out of the recession. There wasn't enough stimulus. It seems like we got it wrong too slow in 2009-10, and we got it wrong too much in 2020, 2021. It's like Goldilocks. It's too hot, too cold, never right.
Yes, we're always trying to learn the lessons from the last crisis. I don't know, a wise man once said that. I don't know who it was, but yes, absolutely. And that's what Joe Biden did. To be honest with you, if I was going to pick one specific example of, that policy support measure was excessive, and that was a mistake. It was Joe Biden's round of stimulus checks it was in 2021, early 2021, when the US economy was starting to reopen. There'd already been very generous support to households. And then there was another round of stimulus checks that were given to everybody. And what did they do? They all just wanted to start buying lots and lots of goods. And I think that it would be interesting. Historical work will be done on this, to the extent to which that stimulus package created all sorts of problems for global supply chains, because you had an absolutely gigantic increase in American demand for consumer goods at a time when supply chains were fragile and goods shortages went through the roof. And that had global ramifications. It meant that from all parts of the world suffered in terms of supply chains being gnarled up by excessive demand principally in the United States. It's very interesting. People talk about, goods demand has been strong across the world, and that's true, right? When you have a recession, we all need housing, and we all need hospitals, and we all need food services. So our demand for services doesn't really change an awful lot. Of course, it would fall. We purr back. We don't go to the restaurant so often and so on in the recession. But generally, services spending will only fall slightly. What really falls is spending on goods. You don't go and do up your kitchen with all new fridges and freezers and things, and white goods and expensive durable goods. You don't buy that new car. You don't get all this nice furniture for your house. So normally, goods spending collapses and services spending merely moderates in a recession or falls a little bit. But what happened this time around across the world was that goods spending was supported. People were at home, they couldn't go out and spend on services, but they had this income that was being supported by the government. So one thing they could do was go on Amazon and start ordering things. So that was common to all major economies. But what was different about the US is it wasn't just that goods spending didn't fall particularly, surged. And that sets the US apart from the rest of the world. It surged, and it surged about the same time as Biden was handing out stimulus checks to people. So that had really big global ramifications.
Okay, given what happened, are central banks doing the right thing? It sounds like this is pretty tough medicine to take to try to solve a problem.
Yes, once again, you could invite me back to your show in 2 years' time and say, did central banks do the right thing by whacking up interest rates as aggressively as they did? And I may give you a similar answer to what I've just given you about the previous question. So it could be the case that they overdo it. It could be the case that the tough medicine that they're doling out now turns out to be way too much, and economies slump into relatively deep recessions, deeper than what I'm expecting, deeper than what economists generally expecting, and certainly deeper than what central banks are expecting. It's possible. It's absolutely possible. This is an incredibly aggressive tightening cycle. This is
far faster than ever before in history, is it not?
I think so. Definitely for 40 years. So I think around the late 70s, early 80s, when inflation was double digits in lots of G7 economies, when you'd had a whole decade of high inflation, there was a very, very aggressive tightening cycle then as well. But certainly in the last 40 years, this is the biggest increase in interest rates that we have seen in advanced economies. So that could mean that we've overdone it, and it could mean that we get deep recessions. But again, I'll come back to what I said earlier. With the information that we have now, are they doing the right thing? I think the answer is yes. With the information we have available now, once again, we are faced with asymmetric risks. On the one hand, we may overdo it, and we may have recessions that are regrettable in their depth and their length. That's absolutely possible. But what I absolutely know, and what the central banks absolutely know, is that sustainable growth is not possible with such high and volatile levels of inflation. We have to solve the inflation problem. This was the problem in the 1970s when policymakers vacillated. They were slow. They were doubting their ability to get inflation down. And consequently, inflation stayed far too high for far too long. And there were all sorts of ramifications from that lasted to the present day. What we want to avoid is a repeat of what we had to go through in the 1980s, which were some very deep recessions, some very painful recessions. And that becomes more likely the longer that inflation stays high. So we've got to sort the inflation problem out. And I think it's entirely reasonable, therefore, to raise interest rates as much as central banks have been doing, because the inflation problem is such a problem. It's not just about high commodity prices. It's not just about the supply chains issue, because goods becoming more expensive. It's also because of a bit of homegrown inflationary pressures, because of this, coming back to what I said earlier about this imbalance between supply and demand. And central banks have the power to redress that, and they are doing so.
So the central banks did two things to keep the economy afloat during the pandemic. One was keep interest rates low. The other thing is something called quantitative easing, where they increased the money supply. And I've read some reports now that the reciprocal of that, the opposite of that, quantitative tightening, has never really been experienced before, and we're not sure exactly how it's going to impact. So the raising interest rates we've talked about for the last couple of minutes. But can you explain to me, you're a really smart guy, so maybe you'll understand this. What is the opposite of quantitative easing and this tightening? How do you do it? And do we know what the impact of it's going to be?
So first of all, with quantitative easing, just to cover ground there. So quantitative easing is the process where the central banks, Bank of Canada, the US Federal Reserve, and so on, create money out of thin air and use those balances to buy up government debt. So they are producing money and injecting that money into the economy and taking government bonds onto their balance sheet. That's what QE is. And that's designed, the whole point of that is, one, to get more money floating around in the system, and two, you're artificially creating demand for government debt. And what happens if the demand of something increases? If nothing else changes and suddenly there's new demand for something, its price rises. Now, so people become richer, people who are holding these bonds are better off. So it causes sort of a wealth effect. The bonds that people are holding in their pensions, in their savings accounts, and so on, those are rising in value. The flip side of that is that the borrowing cost for governments falls. So it accommodates governments to be able to go out and manage, because governments got big budget deficits. They had budget deficits in the wake of the global financial crisis. They have big deficits now as well. And if you want to be able to support governments to be able to manage a situation where you're having to take on a lot more borrowing, you don't want to make borrowing so expensive for government. So that was the point of QE, is to facilitate government expansion and to inject financial resources into the system to try and get that liquidity moving around. Because that was the problem with the global financial crisis, is that we just weren't stimulating the economy enough. Interest rates were already rock bottom, so we had to resort to something else. So we just printed a lot of money. Quantitative tightening is the reverse. So rather than creating money and then using it to buy government debt, you sell the government debt that you already own. So I sell it. So if I'm the central bank and you're the pension fund, I say, can I have your bond, please? You hand it over to me. And then I delete, I hand it over to you. I hand the bond over to you. It now sits on your balance sheet. It's no longer on my balance sheet. You hand me over some cash and I delete that cash. So now rather than creating money to buy bonds, I sell them and then delete the money. So we're pulling money out of the system. So whereas previously we were trying to stimulate the economy by throwing money around into the financial system, now we're trying to slow things down by deleting that, by pulling the money out and deleting it. So that's quantitative tightening. Now it was novel. I mean, the US did start on quantitative tightening before the pandemic. So in sort of 2017, 2018, around then, to a moderate extent. It caused some jitters in financial markets, but broadly speaking, there weren't huge macro implications of that. Today, it's been done on a far bigger scale, but so far, that is not causing tremendous problems in financial markets. It was very well signaled, very well anticipated. It's happening at a gradual pace. So that's quantitative tightening. That's how it's going. It's happening right now, and that's helping to slow down the economy.
Is it all going to work?
Well, I mean, the thing is with quantitative tightening, as you said, it's quite a novel thing. So we don't actually know how effective it is. In theory, it should be making borrowing costs more expensive, because if you're pulling all this money out of the economy, you're creating a scarcity. And when you're creating scarcity, you're making things more expensive. So consequently, that in theory, that's how it should be working. In practice, we just don't have. If we'd seen this quantitative tightening play out about 10 times in over the past 50 years, we might be able to say something about what we could expect in terms of the economic implications of it. But we don't have that sort of historical experience. We are sort of this is new territory, and so we'll have to see how things go.
So right now, you think that central banks are doing the right thing, and you are expecting a recession, but you think it's going to be a mild recession, not a deep one. Is that correct?
That's correct, yes.
Okay. Well, thank you. I think this has been really educational. I want to take a final break and come back and ask you what people should do, what households should do as the final question, and then we're going to conclude our session with you. Thank you very much. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Simon MacAdam. He's a global chief economist with Capital Economics out of London, England. And we've been talking about the economy, obviously. We've been talking about interest rates. We've been talking about quantitative tightening. We've been talking about bank failures in the United States. And is there any contagion around the world? And we've been talking primarily about, governments, big banks, and other institutions. Let's finish with households. So if you were a Canadian household, a Canadian family, and you had to figure out what you were going to do, and you either had a mortgage that came due, or a variable interest rate mortgage, or a car loan that came due, or you needed to think about buying some major appliances or something like that, what are you suggesting? We just hold off on things?
That's what central banks are wanting you to do. That is what this is how its monetary policy is supposed to work. But by making debt so much more expensive, you're supposed to go, well, actually, maybe we'll hold off on buying that new car, or maybe we'll hold off on buying that new fridge, or what have you. So that is exactly what is supposed to be happening. Now, for those households who are fortunate enough to not be particularly demanding a new car, they don't need a new fridge or anything like that, they don't need to take out debt to fund consumption, they may still have a mortgage. And so even if you don't want to take out new debt, your existing debt can become more expensive as interest rates are rising. but it'll only become more expensive if you have to refinance. So if you're in your fixed term period on your mortgage, then look at you, because you're sitting this one out. Your interest costs aren't rising. But for people who are either starting a new mortgage or they're coming to the end of their fixed rate term, they're going to find that they're going to be spending an awful lot more on their mortgage payments. Generally speaking, right, and I must actually stress that that is the general rule across advanced economies, that this is what happens when interest rates rise and the households need to refinance their mortgages. They have to spend more money. In Canada, I believe there are some slight idiosyncrasies where actually, initially at least, as your interest rates, the interest part of your mortgage payments are rising, the principal that you're paying back falls. So the initial hit to your household finances isn't actually as big as it is in some other economies, where you're still paying back the same amount of principal on the loan that you borrowed, but in addition to that, you're also paying far higher interest payments. So it could be that some people have, in Canada in particular, can avoid the big hit to their finances for a while longer. But it really, I think the fundamental question looking over the next couple of years is about how long those fixed rates are. Now, in the US, they're very long. In Canada, I think 5 years is typical. In the UK, things are, 5-year fixed mortgages have become very popular in recent years, and as interest rates were low a couple of years ago, but typically on outstanding debt, it's maybe only 2 years. And then you've got the likes of like Australia and New Zealand, where you've got very, very, very short-term fixed rates, or you've just got a lot of people on variable rates. So those countries those households in those countries are really feeling the pain of higher interest rates a lot sooner than they are in the likes of the US.
So we have some of the highest portions of variable interest rate mortgages ever in history right now, where people were taking advantage of the low interest rates over the course of the last decade or so, and we're just using floating rate short-term debt. Right now, the long bond is cheaper than the current short-term interest rate. So if you had to, what would your advice be to households? Should they term out with a 5-year lower interest rate, or should they stay variable, hoping that everything that you've said is right and that the central banks are doing the right thing, and in 6 months interest rates will be lower and they'll be able to finance then at cheaper rates?
Yes, that's the key thing. Really, what you're asking is, what do I expect the central bank, what do I expect the Bank of Canada to be doing? And as I've said earlier, that you have not had the same inflation problem to the same magnitude as other advanced economies. And I think you've also been getting some good data releases coming out recently that are pointing to some of those sort of pipeline price pressures begin to abate. I think last week your job vacancy numbers came out, which showed that job vacancies are normalizing in the private sector in Canada. You've still got some sectors, some of those sectors that were most hit by the pandemic, they've still got an awful lot of unfilled vacancies. But broadly speaking, in the private sector, things are normalizing. And that's going to be really good to be able to cool conditions down in the labour market, which the Bank of Canada will welcome. So consequently, things are moving slowly in the right direction. And consequently, maybe by the end of this year, the Bank of Canada will be able to start cutting interest rates, or certainly by the beginning of next year. So you'll have to start making that calculation then about, if you think the central bank is going to be cutting interest rates, as I do, and as Capital Economics does, then you'll have to think about, well, where are long rates now and where are short rates going to be? And we think short rates will be falling. So I don't know the precise numbers about what the 5-year fix that's being offered now in Canada, but so I think what value I can add is to say that I expect the Bank of Canada to be reducing interest rates either at the end of this year or the beginning of next year.
Simon MacAdam, this has been a great conversation. I really appreciate you joining us. I got to tell you, I got 2 other questions I really want to ask you, but we're out of time, so I won't be able to. But just to warn you, next time I want to ask you about Brexit, because you obviously are someone that studied it. And then just this weekend, we had a major paper come out with a major columnist say that Justin Trudeau should not run in the next election, and Mark Carney, who was your former governor of the Bank of England, should be the new leader of the Liberal Party and the next Prime Minister of Canada. Fascinating. We should have those 2 conversations at some point in time in the future. Simon, thank you so much for joining us.
Thank you, Brian. Thank you.
That's our show for tonight, everybody. Thanks for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at 11 o'clock in the evening in London, England at www.saga960am.ca. Good night, everybody.